Let me tell you something that most people on Wall Street would never say out loud. The biggest banks in the world are telling you one thing on television and doing the exact opposite with their own money. I have spent over 40 years inside these institutions. I sat in the rooms at JPMorgan where billion-dollar allocation decisions were made before breakfast, and I can tell you from first-hand experience that the public narrative and the private playbook are two completely different documents. Today I am going to pull back the curtain on one of the most powerful and least understood tools in all of investing. It is called the 13F filing, and it is the closest thing you will ever get to reading the private diary of Wall Street's most powerful money managers. If you are not using this information, you are leaving generational wealth on the table. Before we go any further, I need you to do something for me. Hit that subscribe button right now and turn on notifications for Invest with Marcus. This channel is not about hype. This is not about meme stocks or get-rich-quick fantasies. This is institutional-grade analysis delivered straight to the people who need it most, everyday investors trying to build real wealth the right way. Drop a comment below and tell me, have you ever looked at a 13F filing before? I want to know where you stand, because what I am about to teach you today could fundamentally change how you approach every investment decision from this point forward. Let us build this together. Now, let me explain what a 13F filing actually is, because most retail investors have never even heard this term, and that is exactly how Wall Street likes it. Every single quarter, any institutional investment manager with more than $100 million in assets under management is legally required by the Securities and Exchange Commission to disclose exactly what stocks they own, every position, every share count, every dollar amount. This is not optional, this is federal law. And these filings are completely free and open to the public on the SEC website. Think about that for a moment. JPMorgan Chase, Goldman Sachs, Morgan Stanley, Berkshire Hathaway, Bridgewater Associates, every single mega institution has to show its hand 4 times a year. And yet the vast majority of retail investors never look at this data. They are too busy watching talking heads on financial television telling them what to buy, while the institutions behind those networks are quietly doing the exact opposite. Here is where it gets really interesting. In my 4 decades of managing money at the institutional level, I learned a critical lesson. Watch what they do, not what they say. And right now, what the big banks are doing is absolutely fascinating. Let me walk you through the most recent filings and show you exactly where the smart money is flowing. Let us start with JPMorgan Chase, my old stomping grounds and the largest bank in the United States by assets. Their most recent 13F filing for the 4th quarter of 2025, filed on February 11th of this year, covers a portfolio worth approximately $1.59 trillion, spread across nearly 32,000 individual stock positions. Now, the headline positions are not surprising. Nvidia sits at the top with roughly $91 billion in exposure. Microsoft follows closely behind. Apple, Amazon, Meta, Broadcom. These are the names you would expect from the world's largest bank. But here is where the institutional mind reveals itself. And this is what separates professional portfolio management from amateur stock picking. It is not about what they own at the top. It is about what they are adding, what they are trimming, and what they are initiating for the first time. In the most recent quarters, JPMorgan has been aggressively adding to Nvidia, increasing their position by approximately $13 billion. They added nearly $10 billion to Apple and almost $9 billion to Microsoft. But here is the move that caught my eye as a 40-year banking veteran. They added approximately $3.8 billion to Walt Disney. They poured roughly $3.2 billion into SPDR Gold Trust options. And they added about $2.7 billion to GE Vernova, the energy spin-off that JPMorgan's own analysts have called one of the highest quality ways to play the AI data center boom. They also added around $2.8 billion to 3M, These are not random bets. These are calculated institutional moves that tell a very specific story about where the smart money sees value. Now let me decode this for you the way I would have decoded it for $1 billion client sitting across my desk at the bank. The NVIDIA and Microsoft editions tell you that JPMorgan's portfolio managers believe the AI infrastructure build-out is nowhere near finished. But the Disney edition tells you something completely different. Disney is a turnaround and content monetization play. When JPMorgan adds nearly $4 billion to a media company during a period of technological transformation, they are saying that the market has undervalued the company's ability to leverage its intellectual property ecosystem. At the same time, the massive gold trust options positions tell you that JPMorgan's risk management teams are hedging against currency devaluation and inflationary pressure. This is classic institutional behavior. They are playing offense with growth stocks and defense with hard assets simultaneously. That duality is what separates professional money management from retail gambling. Now let me take you across the street to Goldman Sachs, the most aggressive trading house on Wall Street. Goldman's latest 13F reveals a portfolio worth approximately $817 billion with over 6,000 individual positions. Their top holdings mirror JPMorgan in many ways, with NVIDIA, Microsoft, Apple, and Amazon dominating the top slots. But Goldman made some moves that are genuinely remarkable. They added approximately $7.7 billion to NVIDIA, $6.6 billion to Tesla, $6.1 billion to Microsoft, and $2.7 billion to Broadcom. But the move that should have every investor paying attention is their position in IBIT, BlackRock's spot Bitcoin exchange traded fund. Goldman added roughly $2.3 billion to IBIT in recent quarters and has become one of the largest holders of that fund in the world. At one point, Goldman held approximately $3.3 billion in IBIT exposure and nearly $500 million in Ethereum ETFs. Their total crypto-linked exposure through ETFs reached approximately $2.36 billion by the end of 2025. Now, I want you to think about this carefully. Goldman Sachs, one of the most risk-conscious institutions on the planet, has gone from dismissing cryptocurrency entirely a few years ago to building a multi-billion-dollar position through regulated ETF structures. This is not speculation. This is institutional validation. When Goldman Sachs puts billions into an asset class, they have done the research, they have run the models, and they have decided the risk-reward profile meets their institutional standards. At the same time, Goldman reduced its position in the S&P 500 SPY ETF by roughly $6 billion and trimmed IWM, the Russell 2000 Small Cap Index, by about $3.3 billion. They also reduced Taiwan Semiconductor by over $1 billion. What does this tell you? Goldman is rotating out of broad market index exposure and concentrating capital into specific high-conviction names. They are becoming more selective, not less. That is a signal every retail investor should be paying attention to. But here is where most people go wrong with 13F data, and I need to give you the straight talk that nobody else will. These filings have limitations that you absolutely must understand. First, they are backward-looking. By the time you read a 13F, the quarter is already over. Institutions may have already changed their positions. Second, a large portion of these holdings are managed on behalf of clients, not proprietary bets by the bank itself. When JPMorgan shows a $91 billion NVIDIA position, that includes shares held in client accounts, mutual funds, wealth management portfolios, and institutional mandates. It does not necessarily mean that Jamie Dimon personally decided to go all in on NVIDIA. Third, 13F filings only show long positions in US equities and certain derivatives. They do not show short positions, international holdings, fixed income, or private investments. So you are only seeing part of the picture. This is why I always tell my community, use 13F data as one tool in your toolkit, not as your entire strategy. When I managed portfolios at JPMorgan, We used this kind of competitive intelligence to validate our own research, not to blindly copy someone else's homework. The real power of 13F analysis is in identifying themes and trends, not in chasing individual positions. And the themes emerging from the latest round of filings are crystal clear. Theme number 1 is the continued build-out of AI infrastructure. Every major bank is adding to the semiconductor and data center supply chain, from NVIDIA at the chip level to Broadcom for networking to GE Vernova for power generation. Theme number 2 is hard asset protection. The gold trust options positions at JPMorgan and the Bitcoin ETF positions at Goldman both point to institutions preparing for currency devaluation and inflationary pressure over the coming years. Theme number 3 is selective concentration. The banks are trimming broad index exposure and concentrating capital into specific high-conviction names. This tells you that institutional portfolio managers believe the era of everything going up together is over. Stock selection is going to matter more in 2026 than it has in years. Now, I promised you the straight talk, so let me deliver it. I see too many people on social media treating 13F filings like a cheat code. They see a big bank bought a stock and they rush in without understanding the context. That is not investing. That is gambling with extra steps. At major institutions like JPMorgan, every position exists within a broader framework of risk management, sector allocation, duration matching, and client mandate compliance. Pulling one stock out of that framework and buying it in isolation is like reading one chapter of a 1,000-page novel and thinking you understand the whole story. Instead, I want you to use this information the way a professional would. First, look for convergence. When multiple institutions are adding to the same name or the same sector, that convergence tells you something meaningful about where informed capital is flowing. Right now, we see convergence across AI infrastructure, energy, hard assets, and selective technology names. Second, look for divergence from the narrative. When institutions are buying a stock that the financial media is telling you to avoid, or selling a stock that everyone on television is telling you to buy, pay very close attention. That divergence between public narrative and private action is where some of the best opportunities hide. Third, track changes over multiple quarters. One quarter's filing is a snapshot. 3 or 4 quarters of data show you a trend, and trends are far more valuable than snapshots. Let me also address the elephant in the room. Some of you are wondering, Marcus, if the big banks are so smart, why should I follow them? Here is the honest answer. They are not always right. In 2008, the biggest banks in the world almost destroyed the entire global financial system. I was there. I saw it happen from the inside. But what they do have is resources, research teams, access to management, proprietary data analytics, and decades of institutional knowledge. Their collective positioning gives you a directional signal, not a guarantee. And in my experience, a well-informed directional signal combined with your own due diligence is one of the most powerful combinations in investing. So here is my challenge to you, the Invest with Marcus community. This week, I want you to go to the SEC website, pull up the 13F filings for one major institution, and just look at what they are buying and selling. Start with JPMorgan or Goldman Sachs. Look at the top additions and the top reductions. Compare that to what you are hearing on financial television. I promise you the gap between the public narrative and the private action will open your eyes. And once you see it, you cannot unsee it. That awareness is the first step toward thinking like an institutional investor instead of a retail spectator. Before I let you go, I want to say something that matters to me personally. Building generational wealth is not about finding the one magic stock that makes you rich overnight. It never has been. In 40 years of institutional banking, I have never seen it work that way. Generational wealth is built through discipline, through education, through understanding how the financial system actually works, and through making informed decisions based on real data, not social media hype. That is what we do here at Invest with Marcus. That is the standard we hold ourselves to, and that is why I need you in this community. So hit that subscribe button if you have not already. Turn on those notifications. Drop a comment below and tell me which 13F filing you are going to look at first. Share this video with somebody you care about who is trying to build wealth the right way. And I will see you in the next one, where we are going to go even deeper into the institutional playbook. This is Marcus, and remember, the market rewards those who study, not those who guess. I will see you next time. See.